This session is all about understanding investing for someone who's seen many booms and the bust in the market, how he has been such a, standout investor, what Prashant has learned from his mistakes, what his, reflections are, what has he learned about India, and is investing in India very, very different from other markets. So Prashant, fantastic to, meet you again. I always look forward to our
Pleasure.
engaging chats. I'm going to start with something very simple. It is often said in the market that investing by difficult cheez nahi hai. Investing is very easy. Investing is common sense and a little bit of patience. So if investing is so simple, how come you don't have too many billionaires on the street? How come there's only one Prashant Jain? How come everybody is not rich?
No, I think one, I am not the only one. There are quite a few who have done very well in the markets. May not be in a mutual fund format for 25 years, but there are quite a few of them. But yes, it's, equities are a very simple asset class, but as is said, what is simple is always not easy. I think to do well in equities, we need right understanding, which can be very easy for some and can be very challenging for others. And I think apart from right understanding, we need lots of patience, we need tolerance for volatility, and we need the discipline to, one, remain diversified in my opinion, and two is not to deviate or compromise from what you believe is good for the long term.
You started your career as a fund manager. That is not a typical migration for a lot of fund managers. They would start as an analyst, migrate up to the buy side, then the sell side, then the buy side, and become a fund manager. So when did the realization kicked in for you that I wanted to be a fund manager? Because being a fund manager means that you need to understand cycles, valuations, macro environment, interest rate environment.
So Nikunj, this will be tough for you and those in the audience to believe, but fact is, I had written civil services and I had actually qualified for them, for the civil services. I went home to discuss with my parents and it took us 10 days to decide that I would actually not join civil services.
Sarkari naukri versus private naukri.
So I had an offer from SBI Caps those days. They was a day one company and I was at IIM Bangalore. And I joined 10 days late behind my batch. All my other batchmates, I think they hired 14 people that year from IIMs. So I was the last one to join. And when I joined, Mr. Shriram was the GM. And he said very apologetically, son, I am extremely sorry. All the good postings are gone. And all you can do now is equity research. Seriously. So those days, project appraisal, merchant banking, marketing, was preferred over equity research and fund management, and that is how within a short period of 2 years I was made a fund manager.
So if your son walks up to you now, you got two boys, they say, Papa, fund manager ya fir civil service, what will you tell them? Which is the most stable career now for next 20 years?
I think unless you are really passionate about equities, most people say that, but actually they don't know enough of it, and that's why probably it interests them more. But I would say civil services.
Civil
and I will
services.
explain it to you why.
You're not being politically right.
No. I will, data is king. See, it's a misnomer in the country that private sector pays more. Nothing could be farther from the truth. You look at the average salary.
Ms. Goyal is just gone. You should have said this earlier. Where's Ms.
No,
Goyal?
but
She's
it's
there.
a fact. And this entire country, I think, believes otherwise. But see, I think what has happened is because the media highlights only the most successful people in the private sector, who, of course, can draw any amount of salaries. There is an impression that private sector pays more. It is not true at all. The starting salary of an engineer in public sector is about 4 times that of the starting salary of IT engineer. The average salary, and I'm saying average salary meaning the total employee cost divided by the total head count of a public sector company is 60-70% more than that of a leading IT company, because of very large addition to the white collar workforce, large number of engineering MBA colleges. The white collar salaries in India in private sector have actually degrown in real terms.
Okay.
Yes. And but of course, and the final thing is, I think equities are the survival rate here is very low. And I have I've been in this industry for 30 years, and I see the financial services, particularly beyond 40, to retain a good jobs becomes increasingly challenging because your costs keep on going up. And in financial services, the only cost is wages. So if you are not up to it, or if the downturn comes, it is the middle to senior level people who are often the casualties.
So I'll take the clock back when you started your career, and obviously that was a different India. Our GDP was nowhere close to even $1 trillion, must be 100 billion or 250 billion. Today we are at 3 billion, one of the fastest growing economy in the world. We can cry about the fact that growth's come down from 7 to 5, but 5 is the official data. Did you ever imagine that 20 years from now, 30 years from now, when you started investing career, we could have a Tata, TCS, which has a profit of 35,000 crore, or Reliance, which has a projected profit of 40,000 crore? Did you fathom this kind of a size for India?
I mean, to give you a very correct answer, no. I never thought that long. And I have tried to do the best every single day. I have tried to think ahead in terms of investing, but clearly I don't think I ever thought that we would become this large, we would have this big companies. But one thing I must say is that I had a firm belief and a desire to remain in India and to work in India. And I understood this much, that given the demographics, the natural resources, and the capabilities of people in this country, that this country will continue to grow. But clearly, I did not extrapolate 5, 7, 8% growth 30 years out and actually work down that this will become such a large economy.
For those who are worried about slowdown, global growth, drop in autos, do you think the strength of India will prove them again? The strength of India will prove them wrong once again?
Oh, I think for sure India will, the growth will bounce back in India, but it could take a little bit time. See, I think what is happening in India is going back to the same issue what I raised earlier. The white collar wages in India have degrown in real terms, and new avenues of consumption have arrived in India. Like the mobile handset market is as large as the car market. And if you don't have enough money, you would clearly buy a mobile phone over a car. So I think this is what is leading to a drop in consumer discretionary consumption in India. But I think the two steps which the government has taken, one is to cut corporate tax rates. And given the backdrop of the US-China trade war and the fact that Chinese wages are now higher than Indian wages, the manufacturing wages, and their manufactured exports are almost 7-8 times of India. I think a serious attempt is being made and should be made to encourage global companies to set up shop in India. And yesterday I think I read in one of the papers that government has identified 323 global companies to whom they will say, we have lower tax rates, we have a huge local market, this is the piece of land, water, power, what do you want, please come here. I think that is what will revive wage growth and economic growth in India. And I think given the deadline of March 23 for a concessional tax rate for new manufacturing units of 15%, I think sooner than later we should see good movement on that front.
Post the tax cut, we've not seen a large indication or announcement from any of the large corporate houses that look, they're ready to commit capital. Is that the challenge right now, that corporate houses either are scared or they don't have the ability or the will or the scale to commit capital? Because cycles start, investment cycles will start when you have large corporate houses, they start investing a lot. I don't see that happening in any of the large sectors.
See, I think you need to divide potential Capex by private sector in 3 areas. One is some businesses are fundamentally less capital intensive. Let's say FMCG or services businesses. And no matter what taxes you cut, they will not spend more because they simply don't are in that type of a business which needs capital expenditure. The second are the capital intensive businesses, and these are businesses like power, infrastructure, when you build a road, own a road, or metals typically. Now, unfortunately, in these three sectors, which drove the Capex cycle in India last time around, many of the companies are in difficult, they have very difficult balance sheets. Many of them are under the bankruptcy proceedings. And the ones that are healthy, they would rather buy the existing assets under IBC, which are cheaper. I mean, if you look at all the power plants that are being sold or will be sold, they are nearly half of the replacement cost. So as long as existing assets are available to be cheaper, I don't think new capex will revive in the capital intensive sectors. I think this IBC process and the most of the existing assets will find new buyers or new homes by March of this year. And I think post that we should see private capex revive in these areas. And that's why I said earlier that the real opportunity for India in the near term is to get those 300 or whatever global companies into India. Because please appreciate, we buy a Samsung television, we buy a whatever mobile phone. If an Indian company puts up a TV factory or a mobile factory, we will not buy those phones. So our consumption basket, which is tilted more towards imports, we need to bring those companies in, and they can make for India and they can make for the world in India.
You're a firm believer of cycles. It's not that you've not bought consumer stocks in the past. And in 2008, 2009, one of your largest holding was Titan, followed by Page. Now you don't have consumer stocks in your portfolio. Why is that?
So I think, I don't subscribe to this view that good business is a good investment at any price. And that is not borne out by my experience over last 3 decades. So certainly we should buy a sustainable business, but beyond that, for a good business to become a good investment, the price must be good also. And I can give you several examples, like if you bought IT stocks in late 90s, early 2000s, for 10-15 years you made hardly any money because they were so expensive and future growth was discounted by 2000. If you bought FMCG companies in 1995, for the next 10 years there was zero returns, because they were so expensive in 1995. They were growing businesses, they were great businesses then, 95 and 2005 as well. So I think consumer stocks in India today are, to my mind, are trading at lifetime high multiples. Never before in my experience they have traded thus so expensive, and nowhere in the world they trade at even probably half the valuations. So I think while these are good businesses, sustainable businesses, but the expectations from these, to my mind, are unlikely to be met. And let us not forget that many of these are reasonably mature businesses. India sells 2 crore two-wheelers a year. And I think maybe in India there are 15 to 20 crore two-wheelers on the roads. So almost 2 out of 3 families own a two-wheeler. Soaps, shampoos, toothpaste, these are good businesses again. But to expect them to grow very fast, I think is not correct, because they are reasonably mature businesses. So I think we must pay, I want to pay good attention to what price I am buying, apart from the sustainability of a business, and these businesses don't pass the valuation test.
But if one looks at the India story, it is perhaps, with the exception of Reliance, it is centered around consumers, autos, and private banks. You don't have a very large manufacturing company. You don't have anything very large which has become an export front company in terms of manufacturing. Why is that?
So I think that is true, then, because it is hard to explain and probably unfortunate. In 90s, till 90s, India's per capita income was same or higher than China.
Is it true?
Yes. And today Chinese per capita income is 5 times of us. And I think while we made a success in the services industry and India dominates the world, but I think in manufacturing, China went decades ahead of us. And so if you look at the composition of the Sensex today, and you are right, that there are very few manufacturing companies in that. 30% is financial services, 20% like IT, pharmaceuticals, and oil and gas and metals. They are global cyclicals. So that is 50% of the market. Another 20% would be consumer discretionary, non-discretionary. That's 70, and there's only 10% is companies like Larsen Toubro. So you are right that and it shows up in our GDP composition. I mean, what is the contribution of manufacturing to GDP? But I think all is not lost. Today, Chinese wages are, for the first time in my career, in the last 1-2 years, Indian companies in chemicals, textiles, what else, auto ancillaries, they tell us, look, the wages or the cost of manufacturing in India is lower than China. That was not the case 15 years back. The compliance with environmental standards is improving in China. The subsidies are reducing. So India is now competitive in rupees terms. And that is why I think this tax cut has come at a very opportune time, that India offers the advantage. See, look at it this way. Our manufactured exports at 300 billion are roughly the same size as a Vietnam, Thailand, or Indonesia. And they are countries which are 1/10 the size of India. And China is 2.5 trillion. So I think given the right tax rates, given the right environment, and the advantage of a massive local market, which none of these neighboring countries have, I think it is reasonable to expect that many of these global multinationals who are present in China, when they move out of China or reduce their footprint there, India will get in future a higher share than what we have got so far.
So you mentioned the weightage of the Nifty. The weightage of the Nifty in 2000 was very different, dominated by TMT. 10 years from now, 8 years from now, what to your mind could be the face of the Nifty? Because that's why we'll understand that where wealth is going to get created.
So I think it has changed. In 90s it was very different. By 2000 it was very different. 2008 it was very different, and today it is very different. And it probably reflects both the economic growth and which sectors get undervalued or overvalued. Like tech, I vaguely remember in late 90s or early 2000 was almost half of the market weights. But it was reflecting as much the growth of the sector as the overvaluation, because these are market cap driven indices. I think, so let me comment on the growth. Where will growth come from? I think investments should outgrow consumption in India, clearly, to my mind. And unless you do that, it will be very tough for this economy to grow. Household debt in India has gone up very sharply. It used to be 2% in 2000. Today it is 20%. Our savings rate has dipped in last 10 years. In 2010 or 2008, our financial savings rate used to be 12%. Today it is down to 8%. Never before in India has our financial savings rate fallen. I think that is because the white collar wages have degrown. So I think the only way to fix this is to grow your investments. If investment grows, you create more jobs, it gives you more salaries, and then you can come back and spend. And again, most countries that have experienced rapid economic growth in the past, it has been driven by exports. So whether it was Japan, Korea, Germany, it has been China now. So I think when these global companies come to India, hopefully it will increase our merchandise manufactured exports as well. So I think in the future, businesses that will grow faster will be around capital spending, around manufacturing. And of course, financial services, I think, will keep pace with the GDP growth.
The recent downturn which we have seen, and if I look at the quarterly numbers gone by, HUL has managed to grow, Bajaj Finance has managed to grow. Big companies are the only ones which are growing. Are we in an environment where the existing 50, 70, 100 companies will become giant companies, giant will become mega, and mega will become, monster?
So I don't think there can be any generalization to that trend. And we have seen in the past that there were, if you look at NBFCs, for example, many NBFCs pioneered a new area for credit. But over time, as that area became addressable by banks and as it became large, banks entered. and then they gained share back from the NBFCs. And I think the way, for the first time in this season, I think some leading banks offered you loans for very small consumer items. And today in India, you can get an EMI on a debit card as well. So I think over time, banks will be able to address the small consumer loans market, because it will all be digitally delivered and they know their customers extremely well. It will be driven by analytics. So I think while those companies which continue to be ahead of competition, they will do well, and there is always space for companies which execute better. But I think banks will be formidable competition in the days to come, even retail, small retail loans. As far as Lever is concerned, it's a great company. It has outstanding brands, extremely well managed, global best practices. It continues to grow, it continues to premiumize. But Lever continues to grow at broadly the same rates at what it has grown for long periods. So I think Lever's business is reasonably easy to forecast, and where people have different views is what they are willing to pay for that quality and for that growth.
If I look at the track record of the fund which you manage, you've taken contra bets, not yesterday, not last year, but in your entire investing career. You bought stocks, you bought, for example, corporate banks when everybody was focusing on retail banks. You bought into PSUs when PSUs, in a sense, were not the popular trades in the market. You bought consumer names when there was a perception towards infrastructure. How do you come up with a thesis, an idea, and conclude that it's time to go contra? Are you buying it because they're cheap, or are you buying them because you have compulsions of a fund manager? If you have compulsions of a fund manager, it's very easy to map the Nifty and stay with popular stocks. But you never do that.
So I am extremely non-violent by nature. So I don't believe in contra investing, but I do believe in value investing. And if value investing at a point of time means that you think differently from others, then so be it. So I want to, as I said earlier, I have always tried to buy reasonable quality businesses, not always high quality because sometimes they are very expensive. And I have always focused on what you pay for them. And it is quite logical that when a good business is passing through a challenging time, or when some other businesses are doing extremely well on the stock markets, and since most people in life, and I think in stock markets as well, are very short-term focused. They want to avoid short-term pain and get short-term gains. So when almost everyone wants to buy certain stocks in the markets, it is obvious that rest of these spaces tend to become more value. And if you are seeking value, if you participate in that part, then you become a contra investor. So contra is an outcome of seeking value, but seeking value is the key. And I will give you 2-3 examples here. Around 99-2000, the IT stocks were trading at 300-400 multiples. And everyone agreed, even I agreed, that they will continue to grow for many years, which indeed they did. But it is just that more of that growth was discounted than the real growth. And so they were great businesses, growing businesses, but bad investments. And since everyone was buying IT and nothing but IT, almost everything else became so cheap, it is hard to explain. You could have bought BPCL in 2000 for just the value of the LPG cylinders. You could have bought Ashok Leyland for less than the working capital on the balance sheet. So that was one great example. And these businesses which grew slower, but they delivered far higher returns, because if you buy something at 2 or 3p and if it goes to 15p, it is a 5 or 6 bagger. Around 2008, just the opposite happened. This was one time when quality was at a discount. So around 2008, you could buy the consumer companies, the pharma companies, the automobile companies in single digit or low double digit multiples. And we used to own Glaxo Consumer. They make Horlicks at 12p. I bought it at 18 and I saw it fall to 12p. And people used to tell me, "Ki, look, Horlicks is had only by sick or by old people. There is no future to this business." Because that time everyone wanted to buy only the infrastructure, the power, the real estate companies because they were doing well. So I think I have seen this time and again that the definition of quality changes and what is in going up tends to get overvalued. But I must say that sometimes in the last few years, like you mentioned, corporate banks, we have been overweight. It can test your patience because when a business is in pain, it is cheap. And you are buying it in the hope that that pain will go away one day and that business is strong enough to survive that period of pain. And so this SR Steel case, it took almost 3 years to resolve. And we were hoping, given the IBC deadlines, that that resolution will take place much earlier. And that is why value investing can become difficult at times because something in the environment changes and the pain period gets extended. But the key is to buy a strong business so that it is able to endure that period of pain. And you should, of course, be able to endure that pain. And because in the end, if your assessment of value is right, no matter how long it takes, the value does unfold and the investment gives you the returns for the entire holding period.
So if I open to the floor right now, the first question would be, great example on Ashok Leyland, great example on Glaxo, but ab kya sasta lagta hai? So before I open it to floor, why don't you answer it?
See, I'll give you an answer which, you track our portfolio. So what a person thinks is, he likes it most, that's the biggest overweights and underweights. But let me answer that more specifically. See, I think this is my opinion and many people disagree with me. I think the public sector companies are, to my mind, misunderstood by the markets. And there are sectors in which public sector is at a disadvantage, like the service industry. And there are sectors where public sector has a significant advantage, which are resource-rich areas like mining, where you have mines which have been given to you 20, 30, 50, 100 years back, where you have huge economies of scale, or companies or sectors which are very capital intensive, let's say oil or power, or where faith is involved, let's say public banks. So when PMC happens, you will never find a situation like this in a public bank. So ability to collect large amounts of money at low interest rates is a very strong comparative advantage for some of these banks. So I find because of the frequent divestment by the governments and particularly through ETFs in the last few years, this persistent supply, I think, has made these companies very cheap. I think many of these companies, especially in the mining, the oil and gas, some of the strong banks, the power sector, they are very sustainable businesses. And they are very, very cheap. And you can figure that out by just looking at price to book or the dividend yields on these companies. Most people don't like it because if you have bought these companies in last 2, 3, 5 years, you have not done well at all. So they have caused immense pain. But I think they are sustainable businesses. They are trading below their intrinsic values. And what gives me hope is the shift in government strategy towards strategic divestment. So if in future, if that becomes the main route for divesting these companies, one, it will tell us the real value of these companies, what a strategic investor is willing to pay. And hopefully it will also reduce this frequent supply of these stocks in the market.
I'll again hit the pause button here. We'll be taking questions in 2-3 minutes. Get your questions ready. I'm coming to you, sir, but in 2-3 minutes. Lots of hands will come up, Prashant, so be better ready. Just one question on this entire way how markets have moved. Is buy and hold dead or buy and hold will never be dead?
See, I think buy and hold, how do I answer this? I think clearly investing delivers far more returns than trading. And I don't think there is any denying that fact. If someone has to be exceptionally talented as a trader to make money, And unless you have it in you, I think investing is a far more secure and predictable way of making money, long-term investing. That means buy and hold. But it also means that there are two assumptions underlying, two things you need to be careful about. One is you must buy sustainable businesses. You must not overpay. If you bought tech in 99 and you held it for 10 years, it was not a good decision. The day you realize that mistake in 2001, you should have corrected. If you held pharma 4 years back, it was very expensive, and you can see what pain is there. So I think first is you must buy right, and buy right means a reasonable quality business and at not an expensive price. And you hold it as long as you think it offers you reasonable value. As long as your exposure to that stock does not go up beyond what your risk management would indicate, or as long as you don't have something materially better. So if you look at our portfolio turnover rates, they are clearly below averages, much below averages, but they vary sometimes, most of the time between 2 to 5 years.
Okay, last question, then I promise I'm coming to the floor. Let's divide broadly India into three parts. First, where you have evergreen good growth, financial sectors, private banks, their growth, insurance, the growth is very strong. It's 10, 15, 25, that's the only debate. Second part where because of stress or distress, valuations have become up and down, like PSU banks, corporate banks. And third, businesses which you can catch them early, which can become big, like NBFCs or what happened to, let's say, TMT in 1990. So we know that you like PSU banks in bracket 2. What do you like in bracket 1, which is compounders, and what do you like in bracket 3, where businesses are young and they can become big?
So I think a better way to describe my view on banks would be I have liked corporate banks, both in public and private, and both are equally large with us. And simply because they were in pain, their liability franchise was very strong, and the balance asset side was in pain, and you thought that it will become correct, and some of these banks have actually done quite well now. So I think, identifying the third is always a challenge.
That's I'm asking you.
IT was a fairly obvious one in late 90s, and infra growth was there, but it was unsustainable. And today I am not able to find any piece in the economy which will grow extremely rapidly. But I do feel that Capex and manufacturing will grow faster than consumption. But yes, there are sectors like airlines, there are sectors like organized retail, which could grow fast. But fast growth alone is not enough for the markets. The moment you say this business is growing at 30% for next 10 years, you must ask, are you the only one who knows that? Or the whole market knows that? So chances are everyone in the market knows that. And when quality companies are growing in a sustained way, chances are everyone knows that. And so then the next question you have to ask is your growth estimate higher than others? Or will you think growth will sustain longer than what others think or what markets are discounting? So growth investing is very tempting, but most often it pays less than value investing. And because people simply extrapolate the high growth rates of the last few years for very, very long periods into the future. And in 2000, I will give you a good example. There were many reports by consulting firms which were saying that this IT industry will become so large, $100 billion or something in the next 5 or 8 years. And it is only recently that that industry crossed 100 billion IT services. So we were 10 years late. Now the challenge with that was that if that growth rate slowed down, you simply lost a lot of money. So that is why it is not as simple as just buying a business which will continue to grow. Markets made the same mistake in pharmaceuticals. If you look at last 3-4 years, the stocks are down 70%, 60%. Why? Because the growth rate prior to 2014 or 15 in pharma was extrapolated indefinitely virtually. And that's how they were good companies, but they turned out to be not so good investments.
Okay. Okay, let's open the floor now. Sir.
Yeah. Prashant, this is Himanshu Gupta from Fuzzy Logics. You mentioned that the indexes are market cap weighted and therefore certain sectors because of overvaluation can dominate the index. So do you think there is a place for indexes weighted by, let's say, P by B ratio or dividends?
See, I think this is not a question for me to answer, and and it is for the regulators or for the exchanges to decide, and I am sure they know this. This has been debated, but in the end, there is a belief in the market forces, and I think there are lots of merits in having size-based, market cap-based indices as well. So I don't think I would. I mean, I have a clear view on this, but I think on balance, but see, think of it this way, what's wrong with having a market cap based index? As long as you know that this part of the market is overvalued and you have the ability to bet against it, in a way it gives you an opportunity to do better than the markets.
So you're outsmarting the index by...
Yes, I mean, that's one way of creating alpha. If you did not own technology in 2000 and the markets were 50%, it gave you a massive opportunity to generate huge amounts of alpha.
Okay, yes ma'am.
Thank you.
Let the lady ask the question. As it is Indian women complain, men are not schedulers in India. So.
Hello sir, I'm Sonali Sonpal from Millennium Ma'am, Kolkata. As you mentioned that a lot of industries from China would be coming to India. So in that case, which sector do you feel, that they find scope here? Like, is it agrochemical or electronic or it is metal, which would like to come to India?
See, it is the global companies who are present, who have their supply chains in China. And these companies have to come. And when they come to India, India being a very large market, they will make both for India and for the world. I think areas which which have reasonable labor inputs would be obviously preferred, because something where the labor input is extremely low, India does not have a cost advantage, because a company would put up facilities where it is cheapest to manufacture. So I think we have to look for industries either where you have proximity to raw material. India has lots of agri-based raw materials. All the metal ores are there in India. So I think those industries could come. India is a very large market for consumer electronics. So there you may make even for India, because India itself is 15% of the world's population. So over time it will become a very large market. So I think that list, what came in BS, they said 323 companies, but I am sure one fine day that list will be known to us and we will know which companies are coming to India. But I think the first attempt could be in consumer electronics. But please remember, that means little to us, because these will be unlisted plants. And it is basically what mobile handsets or LCDs we are importing, they will be made here. And they will create jobs here instead of creating jobs outside.
Thank you.